Good afternoon, guys. Today, let's talk about what exactly is a fair value gap. Last week, I've been giving you recommendations. I've been showing you the charts where I've taken my positions, and I've been mentioning fair value gap a lot in those charts. So today, I thought I'll let you know what exactly is my understanding of fair value gap, and hopefully, this would help you guys. All right. So on the chart, you can see I have given you an example of a bearish fair value gap. All right. First and foremost, a fair value gap to form, you will need three candles. It's basically a three candle formation. All right. So as you can see in this chart, we have candle number one, candle number two, and candle number three. Okay. So now for a fair value gap to occur, price has to go and close above and high. That high could be anything that you mark on a chart. It could be a previous day high, a previous week's high, a previous month's high, or even a previous day's last high. Okay. Whatever high you mark on the chart, price has to go and close above it. Okay, so that is candle number one. All right, candle number two will be a candle that will open and close below candle number one. Okay, and candle number three will be a candle that will open and close below candle number two. All right, under no circumstance candle number three will touch or close above candle number one high. All right, so I hope that's clear. Candle number three will under no circumstance close or touch the low of candle number one. Okay, candle number two will be the only candle that will be touching candle number one as well as candle number three. Okay, other than that, nothing else will be happening. Okay, now once this occurs, what you need to do is that you need to mark candle number one low with candle number 3 high and make a rectangle like this. This rectangle will be your fair value gap. Right? What's happening over here is that price is only being offered on the sell side. There is no price being offered on the buy side. So basically it's an imbalance that is happening. So what we need to do is that we need to wait for price to go down and then come back sometime in the future and touch this box. Once price comes and touches this box, that's a very good spot for us to go short in the market. All right, we can go short at the high of candle number three. SL could be the high of candle number two or candle number one. Okay, so this is the basic picture of a bearish fair value gap. Good afternoon, guys. Let's talk about how a bullish fair value gap looks like. So this is an example of a bullish fair value gap. As you can see, I've marked a low over here. This low, as I said, could be a previous day low, previous week, previous month, previous day's last low. It could be anything that you consider as a low. We need price to break below it, all right, and then climb back up again. Okay, while it's climbing up back up again, as you can see over here in the chart, I have denoted candle number one, candle number two, and candle number three. So as I mentioned earlier, the bullish fair value gap also is a three candle formation. Right, so the candle number one goes below the low that we have marked on the chart. Candle number two forms and closes above candle number one. Candle number three opens and closes above candle number two. All right, candle number two is the only candle that will be touching candle number one as well as candle number three. All right, so once this happens and candle number three low under no circumstance will touch the high of candle number two or touch the high of candle number one or closes below the high of candle number one. Okay, so I hope this is clear. So once this happens, we will mark a rectangle touching the high of candle number one with the low of candle number three. That would be a fair value gap. All right, now what's happening over here is that price is only being offered on the buy side in this blue rectangle. All right, there's no sell being offered over here. Price is only being offered on the buy side. So what we need to do is that in the near future, on the future, we would wait for the price to come back, touch this level, and we can go long from here. All right, this will be a lovely position for us to take a long because we will have our stop loss either at candle number two low or candle number one low. All right, and the risk reward in this is amazing. Okay, because your stop loss is going to be pretty short. All right, and this particular formation of fair value gap is not constrained to one time frame. You can use it in any time frame. Okay, you guys will open your chart, you mark these levels on the chart, and you'll be surprised at how many times this happens during the day on a 1 minute chart, 5 minute chart, hourly chart, daily chart, weekly chart. You'll be amazed. All right, so just go through it, try to mark this on your chart and see how price reacts to these levels. Now the next question is, how do we identify where these fair value gaps will be formed? All right, so what we need to do is that we need to identify a bearish market shift structure, as in where the market is being shifted from from bullish to bearish. All right, so here you can see on the chart I've drawn this blue line which is denoted with high. So this is, again, as I said earlier, a high that you have marked on the chart. All right, it could be any high that you consider as a level of seriousness. So what we need to do is that we need to see price making a higher high. Okay, as you can see, a high has been formed and a higher high has been formed over here. Okay, so what's happening? Price goes up, crosses this high that we marked on the chart, and immediately comes down. All right, this downward move has to be rapid. Okay, it cannot be any Mickey Mouse moves. When I say Mickey Mouse, it cannot be small moves. The candle that breaks this low over here has to break it with intensity. Okay, now this low that I marked here is displacement low. This is the displacement high. Okay, why displacement low? Is that for a fair value gap to form, or for us to look for a fair value gap, price has to break the low and displace it. It has to displace this low, bring it lower. Okay, so what happens, as I'll say it again, price has to go above a high that you have marked on the chart. Okay, and then it has to come down rapidly. A big candle has to form here rapidly and close below this low. It has to displace this low. Okay, you will find, once this happens, you will find your fair value gap being formed between the displacement low and the displacement high. This is where you will look for a fair value gap. All right, in a bearish market structure. I hope you guys get it. Now let's look at bullish market structure. This would generally occur at the low that we draw on a chart. As I said earlier, the low could be previous day low, previous week low, previous month's low, previous day's last low. It could be anything that you would like to mark on the chart. Alright, so we will need the price to go and break that low that we have marked on the chart. Okay, and collect all the liquidity and immediately break the lower high that has been formed. Okay, now this break that goes above this lower high, in this case displacement high, all right, it has to be swift, it has to be a big candle. All right, the reason why, as I mentioned earlier, we call it a displacement high is that we need the price to come and displace this high, this lower high that's been formed over here, to another place higher. Okay, it has to displace this high. The price has to displace it. Now, it, as I said, it cannot be done by a Mickey Mouse candle, or small candles, or just with a wick. It has to be a large candle. It has to break this high and close above this. Okay. Now, once this happens, you will find the fair value gap being formed between the displacement high and the displacement low. All right, or from this level, the the large candle that broke the displacement high, that candle to the displacement low, we will find a fair value gap being formed over here. And once it gets formed over here somewhere, let's presume that we have a fair value gap that's been formed somewhere over here. All right, we'll wait for price to come back, because as I said earlier, this particular fair value gap in this case, all right, price is being offered only on the buy side. All right, so there's an imbalance of price over here. So we need price to come back touch this fair value gap, and then this would be a good opportunity for us to go long, right? And from here we would expect price to go higher. Okay, so it might go touch of maybe a fair value gap on top somewhere over here. It might go and touch liquidity, you know, sell stops, liquidity up there. Sorry, buy stops, liquidity up there, up somewhere over here. All right. So this is how a bullish market structure would look. All right. Uh, you guys just go through this video a couple more times. You will understand what I'm trying to say. All right. Take care. Cheers. All right, guys. Let's have a look at the Bank Nifty's chart. So as I mentioned earlier, before the day starts, that is before the 4th of August, we mark the high of the previous day, high here, and the low of previous day. All right. This black line that you see over here is the low of previous week, and this green line that you see here is the low of previous month. All right. So I'm now going to show you how I took a short trade, as in the I'm going to give you an example of a bearish fair value gap. All right. So I'm going to go to 3-minute chart. As you can see, price opened up over here, came, touched the previous month's low, and it took a jump from here. All right. As you can see, it took a jump from here. Okay. So now I'll talk about this trade later. First, let's talk about this trade over here, the trade that we took on the short side. Okay. Right. So as you can see, price came, it touched the previous day high, couldn't cross. This particular candle crossed and closed above it. Okay. And then it started falling from there. Okay. So what we first do is that we will mark a displacement high. Okay. Now since from this created a high and the price started coming down, prior to this high, this particular level over here was the low. Before this high of 1145, sorry, before the high of 1148 that was created, okay, the low was over here. Okay, so from this low, price went up, broke previous day high and closed above it, and from the 1148 candle onwards, the price started coming down. Okay, so this was the displacement high that price created, this was the displacement low. Okay, now for a fair value gap to happen, what have I told earlier, that price has to break this displacement low. Okay, and it's going to break with a big candle. No Mickey Mouse candle over here, a big candle. Only then it's got to displace the low. It's got to show the intention that the price wants to go down. Okay, so as you guys can see over here, price did come down. It briefly closed below the displacement low, but it wasn't a big candle. It wasn't a large candle, and immediately price climbed up again. Okay, it went up, it hit again the red line over here, which is the previous day high, and it came down. Now you look at this candle that is created over here, this particular candle. Let me just take this mark out. This particular candle, the 1230 candle, you can see how big this candle is. Look at the body, how big it is. It has displaced this low over here, right? It's pushed the price further down with intensity. Okay, and the next candle, the third candle, okay, let me just mark these as 1 2 3 so you guys would know what I'm trying to say. This would be our candle number 1. This should be our candle number 2, and this would be our candle number 3. So this is a 3 candle formation, as I already explained to you earlier. Okay, now price has come, has closed below this displacement low. This candle did it, but didn't do it intensity. It wasn't a large candle. This candle closed with intensity. Look at the body. The close is also right at the bottom. All right. This closed with intensity. The candle number 3 over here also opened within the range of candle 2 but did not touch the low or cross the low of candle number 1 and close further down. Alright, so once this happens, price has gone above the previous day high, came down, created a displacement high, created a displacement low. Further down time, price broke this displacement low with intensity, alright, created the 3 candle formation of fair value gap. What I'll do next is that I will mark the low of candle number 1 to the high of candle number 3. Alright, this, as I said, this would be our fair value gap, FVG, as I keep mentioning always throughout my conversation. This is the fair value gap that was formed on the high, and after marking this, exactly over here is when I shorted the market, and you can see where price has gone. It gave us a good move of, let's say, around, let's say 45 100, 45 100. It went all the way down to 45 730 levels, right? It nearly touched this fair value gap, which I'll speak about later. But I hope you guys understood, all right, the gist of it. How to mark a fair value gap, where to look for a fair value gap, and when to take a trade. All right. So in this particular trade, as I said mentioned earlier, we will go short at the high of this number 3 candle. We will take a short position. A stop loss could be the high of candle number 2 over here, or it could be the high of candle number 1. Either ways, wherever you would have placed it, price didn't come over there, it went down. Alright, so I hope you guys understood what I was trying to explain over here. If you guys have any doubt, give me a buzz. Cheers.